Okay, I guess it's that time, so let's go ahead and get started. Good morning, everybody. For some reason, it feels like about a month since I've seen you guys. I guess just a lot's been going on since the last time I saw you. I don't know, but it seems like forever. But anyhow, just a couple of announcements this morning. We had a great math chat on Friday. I was very surprised at how well it went. Not that I thought it would go bad, but I mean, I really didn't know what to expect because it was because it was the first time that we did it. I think we had 25 students show up, which out of 1,000 actually isn't all that many. But Zhao and I were betting on how many would show up, and I won the bet, so she owes me lunch. But yeah, we had a great chat. It was a lot of fun. It was a lot of fun for me. Great questions. I mean, we talked about everything from starting your own business to class issues, to business issues, to finance issues, to the Apple Watch. I mean, we talked about pretty much. We talked about the auto industry. We talked about everything in there. So I was very happy about that. We'll have at least one more. I'm going to do at least one more of those. It'll probably be right before Thanksgiving. I have jury duty on the 23rd. Thank you very much. So it'll probably be one day the week before that. I haven't decided exactly which day. I'm going to try and target a time that hasn't been covered already, because the Young Investors Club is a Wednesday night deal. We did this on Friday afternoon. Some of the other events have been covered at other times during the week. So I'm trying to spread out the time across the week as best I can. So as soon as we figure that out, we'll announce that. But we will have one more. And even if you've already done your extra credit, you ought to come, because we had a great discussion out there by Reflection Pond. And I was teasing. I was telling a couple people that it was funny to me because I just said I was going to be out there by Reflection Pond, which is a relatively large area. So I get out there, a couple of students recognize me, and I'm trying to figure out, where the best place is for shade and all that kind of stuff. And it was like seagulls at the beach. Because when you first get there, there's like a couple of them out there, but as soon as you start throwing out the bread, they all come out. And that's what it was like, because as soon as we found our spot and everybody because everybody's scattered out everywhere, as soon as they saw us and found our spot, then they all started flocking over our way, and I thought it was pretty funny. But we had a good discussion, so I really look forward to the next one. Be reminded that the extra credit will be due right before Thanksgiving. I think it's the 24th. Is that right, Kelsey? 24th? Yeah. So whatever it is you're going to do for extra credit, which I guess means I need to do my next chat before the 24th. Figure that out later. But extra credit due the 24th. That means that they have to be in physical possession of your form by the 24th. Okay, that's what that means. So that doesn't mean you go do something on the 24th and then turn it into them on the 28th. Okay, they have to have your form by the 24th. Because we need to start wrapping up grades, okay, so we need to get all this done. Again, we got 1,000 students to deal with here, so we got to get all this stuff recorded. We need to double check it to make sure it's recorded correctly and all that kind of stuff, okay? All right, so we got that. Oh, also, the last thing, I only have a couple announcements for you this morning. The last thing is with the Chapter 9 homework that I released, we're up over 10 homework assignments. Be reminded that I'm only in the course, I'm only keeping the highest 10 homework sets, but I need to set Canvas to do that. And I haven't done that yet. I will do that. Your next exam is next week. And when the exam is over and I'm doing all the grades then, I will do all of that then. So between now and then, your grade on Canvas might be off a little bit. I mean, it shouldn't be significant, but it might be off a little bit, and that will be corrected when we get the exam grades in from exam 3. Okay, so just be reminded of that. Kelly has posted a grade calculator in Excel for you on the Canvas somewhere on there. I think it's under announcements, but she's got it on there somewhere. And you can use that as well. I mean, when all is said and done, Canvas will be your official grade, not the Excel. But like I say, for about a week or so here, there's going to be a little bit of a delay until we program Canvas correctly. Okay, and I think that's it. I don't really like doing that kind of stuff while homework assignments are in progress and all that, because things can get messed up. I start uploading grades in the middle of somebody doing things, get messed up. So the exam time is a nice clean time to do it, because because there's no homework going on and there's no exams going on, so there's nothing that's going to be affecting the grades. Okay, so just be aware of that. All right, and I think that's it. So that was only 5 minutes worth of announcements. That's probably a record this semester. Questions? Questions? No questions? Wow. Okay, then I'll take that to mean that everybody's up to speed. So, everybody good? All right. Then let's go ahead and get started. Okay. We're in chapter 9. We've been talking about the income statement, which we wrapped up last time. Went through all of the details of that. Be reminded, and this is kind of a final exam review. This is going all the way back to day one. Be reminded that when you're looking at a company, I think it would be fair to say, and I think most people would agree, that the best measure of value is cash flow. Okay, that's something you talk about over in your finance class, over in 3403. The best measure of value is cash flow because there's no question about the value. A dollar's worth a dollar, always. Always has been, always will be. Okay, so cash flow is really our best measure, but as we saw much earlier in the course, cash flow can suffer from timing issues. All right, well, you know, if you sell something this month but don't collect the money till next month, it's not fair to say that you didn't do anything this month, okay? It's not fair to say that you didn't create any value this month. We went through all that earlier in the course, okay? So because of that, accrual accounting was developed and is valuable to help more properly reflect the underlying economic reality. Okay, and that's why we have our net income and why we've been doing what we've been doing so far. Okay, well, the statement of cash flow, which is the second half of chapter, of chapter 9, is looking at or is presenting the actual cash flow information about the company. Okay, this is an important statement for at least two reasons. One is what I just said. All right, cash flow is considered the best measure of value, and this is telling us about the company's cash flow. But also because I think that not many people really understand this statement because it's hard. I mean, in practice, what we're going to do in here isn't too hard because it's a much simpler environment. We're not really making simplifying assumptions. We're just dealing with simple transactions. But, you know, in the real world where you have all sorts of, you got mergers and acquisitions going on, and all sorts of stuff going on, it can get very complicated very quickly. All right. So if you guys understand it better than others, then you can make better decisions, in my opinion. So we're going to look at this statement very closely, probably beyond what the book does on it. So be advised, this is an important topic for exam purposes and for final exam purposes. Okay? All right. So statement of cash flow. Let's see. And what we're going to look at here is we're going to look at three things. First of all, we're going to look at the format of the statement of cash flow. Okay. Then we're going to look at how it's prepared. So we're actually going to go through two examples of actually preparing, one fictitious and one real. Okay, and then we're going to look at how the statement is interpreted. Okay, and I have no idea how long it's going to take us to do all that, so we'll find out. All right. So since you guys are tired of Home Depot, I found another company for you. So I dug up Microsoft. All right, and I did this 5 minutes before class, so I really haven't analyzed these statements, but I think we'll be okay. All right. So let's take a look at the format of the statement of cash flow. All right, we'll get back to that PowerPoint in just a second. I saw a lot of you writing it down. Don't flip out. We'll get back to that in just a second. Okay, so here's the income statement, which we just finished talking about. And by the way, for the record, notice coming all the way down the income statement, we have our net income here. Then we have our earnings per share information that we just finished talking about, basic and diluted. Weighted average, and then they give you the weighted average shares outstanding, and so forth and so on. And down here they have their comprehensive income information, which we've talked about as well. Okay, so all of this should mean something to you now. All right. All right. So let's take a look at the statement of cash flow, which is right here. And the statement is, first of all, it always starts with net income. Okay. And the statement is broken up into three sections, but there's two purposes of this statement. What's the first one? And yeah. Okay, the statement of cash flow is telling us how the cash is flowing. Okay, I couldn't resist that one. You're right, yeah, by the way, but I couldn't resist that one. Okay. Well, yeah.
How it changed during
Exactly. Okay, exactly. The first purpose of this, or one of the purposes of this, notice that on their balance sheet, okay, they had cash and cash equivalents goes from 6938 to 3804. Okay. The first purpose of the statement of cash flow is to show how they went from 6938 to 3804. Right. So if you jump over here to the statement of cash flow, all right, it has all the cash flows on there. And at the very bottom, cash at the beginning of the period, 6938. Cash at the end of the period, 3804. The difference is 3134. So cash went down by 3134, and all of that tells you why. Did they invest money? Did they borrow money? Did they collect money? So forth and so on. Okay. And notice that the 6938 here, 9610, so forth and so on. Okay. So that's the first purpose of it. Okay. The second purpose, which is probably more interesting, is what it does is it reconciles the accrual basis net income to the actual cash flow. More specifically, excuse me, it recognizes the accrual basis income. Remember that, 21,863 over here on the income statement, 21,863. Okay, so that's their net income on the income statement. So it's reconciling the accrual 21,863 to the actual operating cash flow, which is in this case 28,833. Okay. And that's probably the more interesting part, and that's what we're going to talk about quite a bit after we look at how it's prepared and everything when we get into interpreting the cash flow. Because the closer those two numbers are together, the better. I'll leave you with that teaser for the moment. Okay? Questions so far? Okay. Notice that the statement starts with net income. And I don't use this word very often, but it always starts with net income. Okay, so that's the first part because again, one of the purposes is to reconcile net income accrual basis to the actual cash flow. Right? So we've got net income, and then the statement is broken into three sections: operating. Okay, so notice net cash flow from operations, investing, and financing. And usually you see investing first and then financing. I'm not sure why they have it flipped around on here. Okay. But three sections: operating, investing, and financing. Okay. So what that's doing is it's capturing the cash flow from each of those activities. Okay. What was their cash flow from their core operations? What was the cash flow from their investing activities? Did they invest a lot of money or did they receive a lot of money? And then the cash flow from financing activities. Did they borrow a lot of money? Did they have stock issue? Did they pay back a lot of their debt? So forth and so on. Okay, I was very surprised. I had lunch a couple months ago with a partner in one of the local CPA firms down here who will be Kelly's new boss in about a year when she starts her internship. And we were talking about... Of all things we could be talking about, we started talking about the financial statements. And I was very surprised to hear her say that she thought the statement of cash flow was the most important statement in the financial statements. I was very surprised to hear that because usually what I would expect is people say the income statement, followed by the balance sheet, and then the statement of cash flow. So I was very surprised to hear her say that. And her reasoning was for what I just said, which is it shows them, well, where did they spend their money? Were they investing it? Were they paying off debt? Were they spending it in their operations? Where were they spending their actual cash? Okay. All right. So with that, this is the textbook version of what we just saw. So it starts with net income, and then it's going to be broken down into three sections: operating, investing, and financing activities. Okay. Basically, leave yourself a little bit of room in your notes right here. Basically, what's going to be under operating activities is changes in current assets and current liabilities. Leave yourself a little bit of room to write because we're going to come back to this in just a second. So when we're, and by the way, in my opinion, the best way to really understand how this is, to understand what this is presenting is to learn how to prepare it. Okay, I haven't been big on that with you in this course because you guys aren't accounting majors, but in this case we're going to make a bit of an exception. So we're actually going to go through the preparation of this. Okay, so how do we prepare? Well, operating activities captures changes basically in current assets and current liabilities. In other words, the operations of the business. Okay. Investing activities will report the changes in long-term assets. In other words, what did the company invest in? And then financing activities would be long-term debt and equity. Okay. How did the firm raise its money? Okay. Or is it changing its capital structure? Okay. So in terms of actually preparing the statement of cash flow, this is basically how it's done. Yeah.
Repeat what investing activities was again?
Investing, changes in long-term assets. Long-term assets. Okay. Others, yeah.
What about operating?
Changes in current assets and current liabilities. Okay. So from the top, all right, operating activities basically is going to report the changes in current assets and current liabilities, which is the operations. Okay. Working capital, by the way. Okay. The investing section is going to report basically the changes in long-term assets. Okay. Financing activities will report basically the changes in long-term debt and equity. Okay? Other questions? Okay, but there can be some exceptions to this. All right. What's the, for example, final exam review, what's the difference between accounts receivable and notes receivable? Final exam review. Yeah.
Notes receivable are long-term, accounts receivable are within 1 year.
Well, okay, notes receivable could be long-term, but let's say they're short-term, current assets. Yeah.
Accounts receivable is when you're receiving something, a note is like a loan that you're going to receive back.
Okay, that's true. Help me out.
Notes receivable is something that is outside your normal scope of business.
And accounts receivable are?
Or something that's within the
Outstanding. Okay. Accounts receivable arise as a result of the ordinary course of business. Notes receivable, particularly if they're long-term, but you can also have short-term notes receivable, are usually something outside of their ordinary course of business. Therefore, they're not really part of their operations. Okay, so what will also go under investing well, actually, I'll play this next. I was talking about, well, no, that would be assets. Under investing activities would be non-operating current assets. Non-operating, sorry, this is a little small, current assets. Okay, so under the operating section, you're going to have changes in operating current assets and current liabilities. Okay. Under the investing section will be reported changes in non-operating current assets and long-term assets. Okay. Same thing with financing. Okay. So under the financing activities, financing will report non-operating, sorry, this is small, current liabilities and long-term debt and equity. That sounded a lot harder than it really is. Let me summarize that, make sure we're on top of this. Under the operating section, what that's going to report is changes in operating current assets and current liabilities. So far, so good? Okay. Under the investing section, what's basically going to be reported under there is changes in long-term assets. But you will also see, or you may also see, changes in non-operating current assets, because they're not part of operations. Okay? Financing, you're going to see changes in long-term debt and equity, But you might also see changes in non-operating current liabilities because, again, they're not part of operations. Okay, accounts payable versus short-term notes payable. Excuse me. Okay. All right, questions so far? Let me see where I'm at. Yeah. Questions? Thought I heard somebody saying something. Questions? Go with that. Yeah.
So the notes payable will go under finance activities and notes receivable go under investing?
Yes. Note payable would be under financing. Note receivable would be under investing, assuming it's non-operating. If it was, well, you wouldn't have it as operating, but yes. Other questions? Other questions? Okay. Something that I didn't point out on the real one over here in Microsoft, and yeah, this is a good one. Okay, notice that what we have on our statement, first of all, the statement starts with net income always, okay, and then next, what you will see is adjustments for non-cash items that are in the income statement. Now, this is a real world statement of cash flow, so there's a lot of stuff in here, which is where it gets complicated, by the way. Okay, but what you'll almost always see as the next item is depreciation and amortization. Okay, and this one item right here, I think, does the best single job of illustrating what the statement of cash flow is all about. Okay? Because if you'll recall, this is hugely important. Depreciation is a non-cash item. So if you're running your business and you take depreciation expense, let's say of $10,000 for that year, have you actually spent $10,000 that year? No. It's just spreading the cost of an asset over the useful life of the asset. But your net income went down, right? So if you're going to reconcile your net income to the actual cash flow, then in your case, you're going to have to adjust the net income back up by the $10,000. Make sense? That's what they're doing right here. Okay? So you've got net income, and then you have an add back for your non-cash items, okay? Which is depreciation, but that's not necessarily the only one, because you could also have amortization, and you could also have depletion. Okay? And they actually have depreciation, amortization, and other. I'm not sure. If the only other is depletion, I don't know why they just said that. I don't know why they would have depletion, though, but whatever. And that's, again, I mean, I'm saying that jokingly, but these things get really complicated. I mean, even when we were doing this in the real world, you know, partners with 20, 25 years of experience would still have to break out the Advil when we were doing this in the real world for clients. Very complicated. Okay? All right, and that's what we have right here. Okay, so the net income is going to be adjusted for non-cash items. All right. So far, so good. Okay. I think we've already talked about this, because this is talking about cash flow from investing activities. I'm not sure what happened to the financing activities here on these on the PowerPoints, but they're talking about investing activity. But we've already talked about this. This is just a longer definition of what we've already said. Okay, and the next one is I don't recall exactly how wound up the book gets about this, but there are two formats of the statement of cash flow that are allowed under GAAP. One's called the direct method, one's called the indirect method. I don't know of any company that doesn't use the indirect method, which is this right here, which is what you just saw with Microsoft, which is the example that you just saw, the example that we're getting ready to do. So this is what we're doing, all right? And the reason most companies do it is because under the direct method, all right, under the direct method, they don't have to do all this investing and financing and all this stuff down here. It's kind of like the single step income statement where it's just revenue, expense, net income. That's kind of what the direct method is. But for some reason, well, I understand the reason, but under the direct method, they would be required to do this reconciliation anyways. So companies say, well, if we're going to have to do that anyhow, we might as well just use the indirect method. If I ever get a chance to have a lunch with a member of the FASB board, then I will ask them why that is. Until that time, don't ask me, because I don't know. All right. So indirect method. All right. And don't worry about the direct method in the book. So far, so good. Okay. So with that, the best way that I know to actually really start understanding this is to do it. So let's take an example. All right. And the point of this, and I'm going to be doing this on Excel, and don't say, well, we don't have Excel on the exam. I know that, okay? But the point of this is to understand how this thing is put together. And when you're doing this at home, on the homework and so forth and so on, you can really use Excel here to help you understand it. All right, because on the exam, what I'm going to do is I'm going to get on there, and I can't ask you to prepare the statement on the exam, but what I can and will do is ask you questions like calculate cash flow from operations, calculate cash flow from the investing activities, calculate the cash flow from financing activities. Okay, I'm not going to ask you, well, if I were going to give you some curve points on the exam, then I would ask you to calculate the change in cash for the year. And if you can't do that, then you don't deserve the exam points. I mean, I'm semi-teasing about that, but that's just the change in cash for the year, all right? Okay, so let's go ahead and walk through this, and I want you to tell me how to, there we go. I want you to tell me how to do it. What we're looking at is the changes, okay? So the first place I'm going to start as soon as I get everything set up here so that I can kind of work a little better is the changes, all right? So in this fictitious example, which by the way I pulled from another class, but in this fictitious example, cash went down by $11.99. Can everybody see? Can you see it okay in the back? Okay. Cash went down by $11.99. All right. So what we're going to do, and like I said, this is a good way to study this, is to do this and then delete it and start all over again. Okay. On your homework, I believe I need to go double check, but I believe you have the what's it called? I want to say amortization. The algorithmic. Let's start with an A. Algorithmic problems on the homework, so you can do it on. You can use that as well. Okay, but calculate all the changes there, so that's on our balance sheet. And by the way, what we are doing is going down the balance sheet. Okay, so those are the changes on the balance sheet. And then the income statement is down here. Okay, so sales, so forth and so on. Notice we have bad debt expense, amortization expense, depreciation expense, so forth and so on. Net income, $49,783. So what we're doing is we're preparing the statement of cash flow for the year 2008. Okay, everybody with me? All right. So I'm just going to do it over here, and it's not going to look pretty, but we're not interested in the format. We're not interested in making it look pretty. We're interested in getting calculations and understanding the numbers. Okay. So statement of statement of cash flow has three sections. What are they? Operating. So I'm just going to put that up here. Investing. I'll just put that down here for the moment, and then financing. That will get us down to the change in cash. And one of the things, in fact, this was one of the things that initially attracted me to major in accounting, is we'll know whether or not we're correct overall because, we already know what that answer is. $11.99, decrease. So when we're doing this, if we don't get a decrease of $11.99, we know we're wrong. We know that we're wrong. Okay. Now, if you do get $11.99, that means overall you're correct, but you may still have some misclassifications in there. Okay. But at least you're off to a good start. Okay. At least you're off and running. Okay, so changing cash, and then we could put down here beginning cash and ending cash, which we don't really need to take the time to do that, but if we were going to prepare it formally, we would do that. Okay? All right, so those are the major sections. The first line of the cash statement of cash flow is always net income. Net income. Okay, so in this case, that will be 49,783. So far, so good? Make sense? All right. Next line, even though it was a tad bit different on the Microsoft statement, for generic purposes, the next line will always be not necessarily depreciation, but not cash, but the other one. Non-cash. Okay. The next one will be non-cash items that are on the income statement. Almost always that's depreciation. Okay. But be reminded, depreciation is not the only one that can be on there. Amortization, depletion, actually bad debt expense as well, but we'll get back to that in a minute. Okay. So we'll have depreciation on here, and in this case, we do have depreciation. So if you'll allow me to abbreviate. And it's a negative, so I need to make this a negative. Are we adding it or subtracting it? You're adding it because net income was reduced by this non-cash item. So to reconcile it to the actual cash flow, you got to add it back in to bring net income up. Okay? This is really important. You might want to write this down and put it in like a box or something because we're going to get back to it. Okay? That's an example of an income decreasing accrual because depreciation decreases net income. That's an example of an income decreasing accrual. Okay, we'll get back to that. Okay, so we have on our income statement, and I'm going to put little tick marks here just to keep track of what we've used. Okay. So depreciation, any other non-cash items on here for 2008? Amortization for sure. So amortization expense was, I believe, $10,000. And notice that I'm using good Excel technique by using formulas. Not that that's going to be on the exam. Okay. So this is the same conversation that we just had with depreciation. Okay, is there anything else, any other non-cash items on here that jump out at you? Who said that? Say it again. Outstanding. Outstanding. Notice that bad debt expense is on here. Okay. We talked about that quite a bit. Now, final exam review, recall that this actually could be the direct method, which means it actually could reflect a drop in cash, but probably not. Probably not. So for 99.9% of the time, that's not going to affect our cash. So where would that go in the statement of cash flow? Operating, investing, or financing activities? Operating. That would be under the operating activity, but we don't need to worry about that in this particular case because notice that our receivables are reported as net account receivable. Remember, I've always told you to pay attention to the word net. So in this case, that net accounts receivable means the bad debt expense is taken care of right there. It's reflected right there. And this also will go under the operating section. So we don't need to worry about bad debt expense down on the income statement. Okay, that's a little bit further than I will probably go with you on the exam, but just for the record. Okay, and again, it kind of illustrates how these things, even in simple examples, they can get kind of complicated kind of quickly. Okay. All right. So far, so good. Okay. So now that we have this, what we're going to do is we're going to simply go down the balance sheet. Okay, so operating section, what we're going to put in there is operating current assets and current liabilities, the changes in operating current assets, current liabilities. Okay, so cash is what we're proving, so that we don't need to worry about that. Net accounts receivable, is that going to go under operating activities? Of course it is. Okay, now here's the trick with the statement of cash flow. This is the trick right here. What you need to understand is whether the change is going to increase or decrease cash. Okay, I could give you a mathematical proof that is actually very interesting, but it would make it appear harder than it really is. Okay, and the trick here is if you can remember just one account, then you've got it. Okay, because all of the assets move in the same direction, and all the liabilities and equities move in the opposite direction. Okay? For example, and to me, the easiest one to remember is inventory. You can pick really any asset, but to me, inventory is the easiest one to remember. If inventory goes up, then would that generally reflect an increase or a decrease in cash? A decrease, because you had to go out and buy the inventory. Therefore, your inventory is going up, your cash is going down, right? Inventory is an asset account, right? Okay. Therefore, all increases in assets decrease cash. Okay. Similarly, all increases in liabilities and equity increase cash. So it's the opposite. Okay? So that's why I say, and if you don't like inventory, pick another one, okay? Because we're not talking about the fact that maybe inventory was purchased on account, okay? That's not what we're talking about. What we're looking, is that what you're going to ask? Yeah. What we're looking at is the relationship, okay? What if buildings went up, then would that reflect an increase or a decrease in cash? A decrease, because you got to go buy the building. Okay? If notes payable went up, would that reflect an increase or a decrease in cash? That would reflect an increase because you went out and borrowed money. Okay? That's just looking at each one individually. Okay? But let's say that you went out and purchased $10,000 in inventory on account. Well, what happened to your cash? Zero. The net effect is zero. But when we put it on the statement of cash flow, assets will go up by $10,000. Therefore, cash goes down by $10,000. But current liabilities will also go up by $10,000. Therefore, cash goes up by $10,000. Therefore, the net effect is zero. I love it when I hear, That's one of my major rewards in this profession. I wish I could give extra credit for that. Okay. All right. Questions. What we just did right there was the whole banana. That was it right there. So if you didn't understand that, hit rewind on your thing there and listen to all that again. That is one of the things that I do like about lecture capture. That was an important discussion right there. That's one where you want to go back and listen to it again and again and again until you get it. Because that's the whole trick right there. Okay? Questions? Okay, so what did we just say? If assets go up, which they did in the case of receivables, then that represents a decrease in cash. Right? What about inventory? Is that going to go into the operating section? Yep. Okay. All right. So we've got these two taken care of. What about property, plant, and equipment? Is that going to go into the operating section? No. That's a long-term asset. So in terms of our assets, these are the only two that are going to go under operating activities. Right. So far, so good? Okay, so let's jump down to current assets. Accounts payable, is that going to go under operations? Yep. Okay. And accounts payable went down, therefore cash is going to go down. Okay? Because remember, it's the opposite. Assets go up, cash goes down. Liabilities go up, cash goes up. All right. We have short-term notes payable. Is that going to go under operations? No, even though it's a current liability. See, I threw this one on here on purpose, and I threw amortization on here on purpose. I put amortization on here to remind you that depreciation is not the only necessarily the only non-cash item on there. I put this on here to remind you that under the operating section, all you're looking at are operating current assets and operating current liabilities. Okay? So this is not part of their operations, therefore it would go under, just while we're on the topic, under financing. Go under financing. So we'll get back to that in just a minute. Okay. So far, so good? Okay, so cash flow from operations. Here's one exam answer right here. Question: calculate the cash flow from operations. Answer: 38,801. Okay, so far so good? All right. Being reminded that what we just did was, among other things, we reconciled the accrual basis 49,783 to the actual cash flow from operations of 38,801. And by the way, remember this entire discussion when you're over in your finance classes talking about cash is king. I agree that cash is king, but I also agree that there's value in accrual accounting. Okay? All right, so then moving on. Investing is going to, what type of items we're going to put in investing? Long-term assets and also non-operating current assets, if there are any, which we don't have in this case. Okay? So in this case, we have, property, plant, and equipment, which went up by 50,000, therefore cash will go down. Okay. We also have changes in accumulated depreciation of 9167. Is that going to go under investing activities? No, that's part of the operating activities, and we took care of that on the income statement with depreciation expense. Now, again, this is an area, this is a simple example. What I did not include on here was disposal of assets, where some accumulated depreciation was taken off the books. I didn't put on here, well, some assets were started to be depreciated this year. Other assets were fully depreciated part of the way through the year. So again, we can get into Advil headaches real quick here. Okay, so this is a simple example.
Are we going to have to do that? Like, is this just started at this date? Or is it to be
I would focus on what we're doing in class. So everything on the exam we have covered in class. All right, so we don't need to do anything with that because we already took care of it. With me on that? I'll go ahead and put an X there just in case. Okay, patents. Okay, the change was 0, so there's nothing to do. But if there was a change there, where would it go? It would go under investing. It would go under investing. Okay. But there's nothing there. And then we've got accumulated amortization here. Change of 10,000. We've already taken care of that with amortization expense. So same conversation that we just had with depreciation. And there we go. Okay. So cash flow from investing is simply the 50,000. Okay. So now we're starting to get a feel for what this is actually telling us. Okay. Well, their cash actually went up by almost $39,000 as a result of their operating activities. Okay. Now, they took, well, not of that, but in addition to that, they took $50,000 in cash and actually made an investment. Okay. So just stopping right here for a second, you'd be surprised how many people run small businesses, run their business by looking at their checking account balance at the beginning of the year and at the end of the year. And they figure if they have more cash at the end of the year than they did at the beginning of the year, they're doing good. Well, by that logic, by that faulty logic, by the way, just looking at these two items, their cash went down for the year. So using that superficial analysis, the naive analysis, which is what it is, you would say, well, the business isn't doing very well because they have less cash now than they did the year before. And that's not necessarily true. Their cash did, in fact, go down. But the reason they went down is because they invested it. Why did they invest it? To make a future profit, even though they haven't received that profit now. And that gets back to the timing differences in actual cash flow, which gets back to the value of accrual accounting. Okay, that was important. Everybody with me on that? That was an important discussion. Questions? Questions? Okay, good. All right, so that was investing. So now we're down to the last part, which is financing. And what's going to go under financing? Long-term liabilities and equity, but also non-operating current liabilities. And in this case, we have one. And that's the short-term note. Remember that? We talked about that a minute ago. Okay. So short-term notes payable went up, therefore cash went up. Okay, they borrowed money. Okay, so again, all you got with whether or not cash goes up or down, all you got to do is remember one account. Whichever account makes the most sense to you, remember that one account, and then everything else follows from that. Okay. All right, so we got notes payable. Long-term debt, there was no change, but if there had been a change, it would go under financing. Common stock, there was no change in common stock, but if there was, it would go under financing. Additional paid-in capital, no change, but if there was, financing. Retained earnings changed by $49,783. Where does that go? That's part of the equity section. That is not under financing because that change is due to, no, final exam review, important final exam review. This is one of my main goals for you in this course. How does retained earnings go from the beginning of the year to the end of the year? It's increased by net income and decreased by dividends. So this change here represents net income and dividends. So far, so good. Here's potential exam question areas right here. Okay, this change represents net income and dividends. Well, what was their net income? $49,783. The change in retained earnings was $49,783. Therefore, exam question, how much do they pay in dividends? Zero. Zero. That's financial statement analysis right there. That's financial. And it's not intuitive when you first look at it. When you're first learning this, it's not intuitive. Okay? You got to think it through. Well, the retained earnings went up, but how does retained earnings change? Well, we go through what we just did. Okay? So in addition to knowing that we don't have to do anything with this because it's already taken care of up here in the operating section, which by the way is what it is, we also know that the company didn't pay any dividends. Okay? Now, if the company had paid dividends, then they would go where on the statement of cash flow? Not under investing, but under financing. Under the financing section. Okay? So if they had paid dividends, it would go under there. But we know they didn't. And there was a hand, I think, over here somewhere. Questions? Yeah. Okay.
So you know that the retained earnings didn't, you know that they didn't pay dividends because retained earnings increased by the net income? That's how you know
Yeah.
they didn't pay dividends.
Yeah, we know they didn't pay dividends because the change in net and retained earnings is the same as the change in net, change in net income. Whether it increased or decreased. Could be a net loss. Either way. Yeah, if those are the same, then we know. If they're not the same, then the difference, let's say retained earnings went up by $39,783. Then how much did they pay in dividends? $10,000. Okay, let me say that again, even though you could hit rewind. If the actual change in retained earnings here was $49,783. My question was, what if it had only gone up by $39,783? How much was there? How much did they pay in dividends? Exam question. Answer, $10,000 because net income was $49,783. Okay. Everybody understand that? That was a hot topic right there. Questions? And I'm saying that for a number of reasons, one of which is one of the motivations for this course is when you graduate UCF, particularly with a finance degree, really any degree, but particularly with a finance degree, you should know what retained earnings represents. I mean, that sounds silly to you guys because this course was created and I've been harping on it. You know, and that's good. It should sound silly to you, okay? That's good. That is a compliment to you guys, all right? In the absence of this discussion, it has not always been obvious in the past. Not because anybody was stupid or anything like that. One of the things that we talked about at the chat is the fact that teaching is a craft. It's not a science, it's a craft. It evolves over time. You get better over time. Course curriculum evolves over time. Course content evolves, all that kind of stuff. All right, questions? Other questions? Other questions? Okay, did we take care of everything? Looks like it. Okay, so our cash flow from financing is increase of $10,000. So our total change in cash, if we did all this correctly, $11.99. That's what we have right up here. So that we know that in total we're correct. Okay. Again, whether or not our operations investing financing is correct, we don't know, but we know that overall it's correct. Okay. So again, their cash went down that year. Oh, well, we have less cash this year than we did last year, so we're not doing very well. Not necessarily. Not necessarily. Why did it go down? Well, your operations contributed $38,801. Okay. All right. You also borrowed $10,000. Okay. So that's $48,801, and then you turned around and invested that plus a little more for $50,000. Okay. Now, if there was no investing here and maybe more down here, then, well, maybe why are you borrowing so much money? Well, either because we're leveraging or because we need the money, which is two different conclusions. Okay? And so forth and so on. Okay. Questions? This was the simple one. This was the simple one. Questions? Okay, and you guys seem like you actually are on top of it pretty well, because I know you did at least a little bit with statement of cash flow in the prior courses, right? Yeah. Okay, good. All right, so that was the textbook one. Like I say, we don't need to take the time to put in beginning and ending cash. Okay, so that was the textbook one. I also put together a real-world one. Okay, and this is using your favorite company, Home Depot. I didn't know that we used Home Depot so much across classes. Actually, one of the things we talk about in lecture capture classes, I take that back. It was something else. But anyhow, we all with the Bloomberg terminals. That's what it was. We were having discussions with the Bloomberg terminals about when we assigned projects using that. We wanted to figure out how we could coordinate among ourselves so that we weren't stepping on each other's toes, assigning essentially the same project. Okay. But yeah, I didn't know but I already prepared this, so we're doing Home Depot again. All right. So we got Home Depot for 2015, and it's pretty simple. Prepare the statement of cash flows, and this is fun and interesting because these are real-world numbers, and you have the statement of cash flow to compare it to. I pulled this off of Yahoo Finance. You could pull up Home Depot's annual report like I did yesterday just to take a peek at it, and it's the exact same. It's the exact same thing. Just a word of caution here. I'm doing this to try and give you some confidence and pique your interest in real-world numbers. Okay, this is real-world stuff, but what we conclude on here is actually off a little bit from the real-world numbers. Because again, in the real world, there are all sorts of complexities that can be in there that we really don't have any way of knowing unless we're inside the company. Okay, I suppose that if we really went through all the notes and looked at all the details of the notes, maybe we could kind of figure some things out, but we don't need to go through all that. So it's going to be off a little bit from the real world numbers, but the gist of it will be there. Okay, and I had to make, in fact, I think it was with depreciation. I had to make some assumptions. All right, so this is straight off of Yahoo Finance. I think I summarized it a little bit, but straight off of Yahoo Finance, okay? Home Depot 2014, 2015, so there are the numbers for that. Okay, and that was the assets, liabilities, equity, and then their income statement. Okay. All right. So far, so good. Okay. Why don't we do this? Because we'll take a shot at it. I was getting ready to say I don't think we're going to be able to get through this in 15 minutes, but we'll take a shot at it. So. All right. All right. So here is Home Depot's information that I just showed you on there. So I just copied it over to Excel. So we want to look at the change in all of the accounts. All right, so again, balance sheet and income statement down here. Okay. So while we're practicing this, let's go ahead and throw in the change in all of our accounts. And by the way, you could, if you're good on Excel, you could actually do this a number of ways. So the way I'm doing it is certainly not the only way that you could do it. Also, something I meant to mention a minute ago is that if you're not that familiar with Excel, this is an outstanding opportunity to get more familiar with Excel. I promise you that will help you in the job market, even, yes, you marketing majors, even marketing majors. All right, I'm on the board of advisors for Seminole State College. We had a meeting last week, so I'm sitting in there with probably 20, 25 practitioners. I was the only academic in there other than the ones running the show. I was the only academic in there, and one of the things that they were unanimous on, no question about it, is why the heck don't they know more about Excel than they do? They need to know Excel. Okay, I hear that is the common denominator among all employers. And even if you're going to go work for yourself, creating spreadsheets for your own financial reporting purposes is valuable, to say the least. Okay, so again, just a side note here, not that you're going to have Excel on the exam, but when you're practicing this is also an opportunity to get more comfortable using Excel. Okay? All right, so we got the changes up there. Okay. Again, operating, investing, and financing. So operating, investing, financing. There's a few issues in this one that weren't in the simple one. Okay. So where are we going to start? Net income. Okay. So we jump down here. Net income, 6.3 billion, I guess that is. And there we go. What's next? Non-cash items, starting with depreciation. Okay, so we come down here. They've got depreciation and amortization. We're going to add it or subtract it? Add it. Okay. On depreciation here, when you're practicing this at home, don't get real wound up about this number because I had to estimate their depreciation. They actually didn't give it to me. It actually, back in the notes, I think it might have been buried back in there somewhere, but I didn't go through and dig through all that, so I had to estimate their depreciation here. Don't get wound up about depreciation on this particular example. Okay, understand how it's accounted for on the statement of cash flow like we just did, and you're good to go on the exam. And for real world purposes as well, because if you were actually in the company doing this, then you would know what depreciation is. We're outside of the company, so it may not be fully disclosed, so we may not have all the information. So for purposes of getting through this example, I had to tweak the numbers a little bit. All right, so don't get too wound up about that on this particular example. Okay, so depreciation and amortization. Anything else? Excuse me. Anything else down here on the income statement? Nope, I think we're good to go on that. So the next step is, well, cash is what we're proving. Okay, so the cash went down by 206. So that's going to be our answer at the end of all this.
Are we going to write cash from operating activities?
What about cash and operating activities?
Are we going to write that next and go to the next thing and do the same thing?
Yeah. So what's next in the what do we need to do next in the operating section? Yeah, our operating current assets. So we have net receivables. There's that word again. They went up by 86, so cash would go down. Inventory went up, so cash would go down. Other current assets. Now, again, there might be some non-operating things in here, but we don't know about that. All right, so the best we can do for classroom purposes is just assume that it's operating, even though the reality is that there may be some non-operating in there. And there we go. So far, so good. Okay. All right. So now the current liabilities. Accounts payable went up by 94. Therefore, cash would go up. Where are you? Okay. All right. Current maturities of long-term debt, okay, and because that's a current maturity, that would be considered an operating activity. And then I think they have an other, yeah. They have other down there as well, and I think that takes care of all of our current liabilities.
Two others? There's two others from us?
Well, there's other current assets and other current liabilities. So this is current assets, this is current liabilities. Yeah, I'm just doing some abbreviating here since we're not worried about how it looks. Okay. So exam question, calculate cash flow from operations. Answer, 8,422. Okay. Okay, investing. That's going to consist of long-term assets and any non-operating current assets that we may have, which in this case we don't have. All right. So property, plant, and equipment. And see, they're reporting the property, plant, and equipment net. Okay. Which is going to, it's net of what? It's net of accumulated depreciation. Okay, and this is a real-world Fortune 500 company, so depreciation is going to be really complicated because they're going to have things that were sold and written, and all this sort of stuff. And we don't, if this were an accounting class, then we might dig into that a little more and get a little more wound up about that. But in this class, my goal for you is to understand the relationships. Okay, understand the relationships on the financial statements and how that affects information. So that net is, that number includes, and by the way, it went down, therefore cash went up. Okay, and what I've had to do is just making a depreciation adjustment to make the numbers work out right. So don't worry about this. In fact, I'm going to do this. Whoops. I'm just going to highlight that. Don't get wound up about that on this exam. I'm just having to do that to make the numbers work out right. Okay. For depreciation and amortization on the exam, worry about what we just did on the other example and in your homework. Okay. This is unique because of the real-world complexities that we are not privy to. Okay. All right. Goodwill. It went up. So, first of all, because of that final exam review, they did what? Outstanding. They bought another company. They bought another company because that's the only way that goodwill winds up on the books. Okay? So for that reason, cash will go down. Very good. And final exam review, basically how is goodwill calculated at a basic level? Well, goodwill is carried at book value the entire time, yeah. Tricky way to say it, because what you paid for it is the fair market value.
Your book value minus your
Yeah. Okay. Yeah.
worth on the market.
Okay. Close enough. It's the difference between what you paid for it and the net book value of the assets. The net book value of the assets. Okay. So that's a final exam review from, I think that's back in like chapter 2. So go back and look at that. And then we've got other on here. So we just have to assume that that's investing because that's the best we can do. And so cash flows from investing, there was a decrease in cash flow from investing activities. Would you generally, if you were a shareholder in this company, would you generally consider that good or bad? Yeah, I mean, I guess that's kind of a tricky question because it depends on how well they've been doing in the past. But again, they're investing to make money in the future. So hopefully they're doing it well. Okay. All right, and then last, certainly not least, is financing activities. So that's going to be there. What's going to go under financing activities? Long-term debt and equity. So long-term debt went up, therefore cash went up. Other long-term debt went down. So apparently they paid that off, therefore cash went down. So we got that. Down here in the equity section, common stock, there was no change. So we don't need to do anything there. But if common stock had gone up, let's say, then would cash go up or down? Up. And for those of you on the video out there, every time I ask that question, I'm hearing a chorus of both up and down. Which is the point of going through this exercise with you, is to make sure you get those relationships in your head. Like I say, all you got to do is remember one account. If you can remember one account, then you've got it. Okay. So common stock didn't change. Additional paid-in capital did go up. So cash went up. Okay. Retained earnings went up. So what do we do here? Yeah, nothing because it's taking, your answer is better. Compared to net income, retained earnings went up by 38.15. Net income was 6,345. Okay. So they paid dividends, which I had on the information over there. I forgot how much it was. But they paid dividends of the difference. Okay. So net income went up by that amount, the retained earnings went up by that amount, but net income was that, so they paid dividends of $2,530. And if they paid dividends, then cash, of course, went down. Okay? All right, here's a new one, treasury stock. First of all, what is treasury stock? Final exam review. Buying back their own stock. Okay? It went down. It went down. So is cash going up or down? Ooh. Okay. When you first look at it, it's not intuitive, and I admit I don't do this every day, so I still have to think it through myself. Okay? Remember, treasury stock is a contra equity account. So their treasury stock went from 19 million or 19 billion to 26 billion. So economically, what did they do? They bought back some of their stock. Therefore, cash went. Cash went down. So, not that I would get real crazy with you on the exam, but what I could and may very well do on the exam is throw in an account that we haven't specifically talked about. Because if you understand the concept, it doesn't matter. Now, I mean, like I say, I could get crazy on that, and I'm not going to do that. But I could throw, a simple example. We haven't talked about we talked about it, but in our examples, there were no current notes receivable. Okay? But you know that the operating section is only operating assets, so that would go under investing. Okay? So, like I say, not that I would get real crazy with you about that, but the point of this isn't to memorize up versus down. The point is to understand what's going on. And there was a couple hands. Yeah?
Are you going to put this example up on web courses?
No, for two reasons. It's not on web courses. This is real world. So you can pull up Yahoo Finance or go to their annual report. And like I said, the numbers are a little different, but it's on there, and you've got the video. I mean, you can go back and look at it on there. That's one of the few things I like about the lecture capture. Okay, and so for completion in 4 minutes here, let's make sure we did this right. So we got all that. So hopefully you say a quick word of silence, and we actually got it. Okay. Now, what's interesting is that when you look in the real world, and actually, because I do Yahoo Finance all the time, I actually can pull that up very quickly. So, by the way, this is a website that you should be familiar with, Yahoo Finance. We're looking at your favorite Home Depot company, all sorts of information. If you go to their statement of cash flow, there you go. So this is it right here. Okay. So notice that actually how it's presented in the real world, which is kind of interesting, is they have a change in cash and cash equivalents of 100, but we know it's 206. I mean, I'm not the smartest person in the world, but I can subtract one number from the other, okay? And it's 206. And the difference is the effect of exchange rates, 106. So presumably, and I didn't dig this far into it, but if you think about it, you think it through, it actually makes sense because this is a multinational company. Therefore, they probably have cash, but it's in foreign currency. And the value of that changes, which would be part of their cash and cash equivalents. Pretty interesting. Okay, good class. Next week we will, next time we'll look at interpreting the statement of cash flow and probably start chapter 10 as well. So that'll be what we do next time. Good class. I will see you then.